Something absolutely unprecedented is happening in the global silver market right now, and it's exposing the biggest lie in precious metals. While Western paper markets show silver trading around $60 to $65 per ounce, physical silver in certain markets is commanding prices that would shock most investors. Regional premiums have exploded, delivery delays stretch for weeks, and, in the most dramatic signal yet, the cost of borrowing physical silver has spiked to levels never seen in modern history. We're watching the paper silver market and the physical silver market completely decouple in real time. And when I say decouple, I don't mean a few dollars of premium. I mean a chasm opening up that threatens to swallow the entire fractional reserve system that has controlled precious metals pricing for decades. Let me show you exactly what's happening, why the traditional pricing mechanisms are breaking down, and what this means for anyone who thinks they own silver but is really just holding a paper promise. Because what's unfolding right now in October and November 2025 could be the most significant event in precious metals markets since 1980. Let's start with the numbers that are publicly available, because they paint a picture so extreme that if I didn't show you the data, you'd think this was conspiracy theory. On October 9th, 2025, the one-month silver lease rate in London spiked to 39%. Read that again. 39% annualized to borrow physical silver for 1 month. For context, the normal lease rate for silver is below 1%. As recently as July 2025, it was 6%. By October, it had exploded to 39%. And at the very short end, the overnight rate briefly touched 100%. 100% annualized to borrow silver for 1 day. This isn't some obscure market metric that only academics care about. Lease rates tell you the cost of borrowing physical metal. When someone needs actual deliverable silver bars right now, they have to pay these rates. And when rates go from 1% to 39% in a matter of weeks, it means one thing and one thing only. There is no available silver. But here's where it gets even more dramatic. Silver entered a state called backwardation, where the spot price for immediate delivery trades higher than futures contracts for delivery months or years in the future. This inverts the normal market structure. Normally, futures trade at a premium to spot because there are carrying costs: storage, insurance, financing. But when spot trades higher than futures, it means buyers are willing to pay a premium to get metal now rather than wait. The backwardation reached $2.88 per ounce at its peak. That's the largest backwardation since the 1980s, when the Hunt brothers tried to corner the silver market. But unlike that episode, which was artificial manipulation, this backwardation reflects genuine supply-demand imbalances. Industrial consumers need silver to keep factories running. Investors want it as protection against currency debasement, and there simply isn't enough immediately available metal to satisfy both. Now let's talk about what's happening in London, because London is the epicenter of this crisis. The London Bullion Market Association vaults are the backbone of global precious metals trading. When you trade silver over the counter, when institutions settle large transactions, when ETFs take delivery, it all flows through London. In April 2020, during the COVID crisis, London held 35,667 tons of silver. That's over 1.1 billion ounces. As of July 2025, that number had fallen to 24,199 tons, a drop of nearly 50% from the peak. But here's the critical detail that most people miss. Not all of that silver is available. Much of it is locked up in exchange-traded funds. More is held as long-term inventory by industrial users. Some is stored for wealthy individuals who have no intention of selling. The actual free float, the silver that's genuinely available for immediate delivery to anyone who wants it, is estimated at around 140 million ounces. Think about what that means. Daily silver trading volume in London averages 600 million ounces of net settlements, which implies 2 to 2.4 billion ounces of gross turnover when you account for the way transactions are reported. So every single day, trades representing 15 times the available physical inventory change hands in London. That's fine when it's all paper. But when people start demanding delivery, the system breaks. And that's exactly what started happening in September and October 2025. The crisis didn't explode overnight. It built gradually as multiple pressure points converged. First, industrial demand for silver is absolutely insatiable. Solar panels consumed approximately 232 million ounces in 2024. Electric vehicles use silver in their electrical systems. 5G infrastructure requires it. Data centers need it. These are industries that cannot defer their purchases. If a solar panel factory runs out of silver, the production line stops. There's no substitute that works as well as silver for electrical conductivity and thermal properties. Second, investment demand surged. In the first half of 2025 alone, silver-backed ETFs absorbed 95 million ounces. Global ETF holdings reached 1.13 billion ounces. Every ounce that flows into an ETF is metal that gets locked away. It's not available for industrial use. It's not available for delivery against paper contracts. It just sits in a vault backing shares that investors have no intention of redeeming. Third, mine production is stagnant. Global silver mines produce around 830 to 850 million ounces per year. That number has been essentially flat for a decade. Meanwhile, total demand has grown to 1.2 to 1.24 billion ounces per year. The 400 million ounce gap has to come from somewhere. For years, it came from above ground stockpiles. Those stockpiles are now depleted. Fourth, supply deficits have persisted for 5 consecutive years. The Silver Institute projects the 2025 deficit at 118 to 149 million ounces, but that's just 1 year. The cumulative deficit from 2021 through 2025 is estimated at nearly 800 million ounces. 800 million ounces that had to come out of existing inventories. Fifth, refinery bottlenecks created a choke point. When silver prices surged in 2025, millions of people decided to sell their old jewelry, silverware, and coins. Refiners were flooded with material. But refineries can only process so much metal at once. Backlogs built up. Some refineries extended processing times by a full week compared to normal. Others simply stopped accepting new material for days at a time because they couldn't handle the volume. And here's the kicker. Refiners finance their operations by borrowing silver through the lease market. They take in scrap, refine it into good delivery bars, and sell the finished product. But during the refining process, they're holding inventory. To hedge their price risk, they short futures and borrow physical silver to cover the time lag. When lease rates spiked to 39%, that financing model broke. It became uneconomical to refine silver at all, so refiners across the industry paused purchases. Some stopped entirely for days. Others drastically reduced their buy prices. The Royal Canadian Mint, which usually minimizes the impact of lease rates through careful financial management, announced it would halt additional silver coin production for 2025 after meeting its quotas early. The financing costs were simply too high. Now, add one more factor that almost nobody is talking about. In September 2025, the United States designated silver as a critical mineral. This triggered uncertainty about potential Section 232 tariffs, the same mechanism used for steel and aluminum. If the U.S. imposes 25 to 50% tariffs on silver imports, it would completely reshape global trade flows. Traders don't want to ship silver across borders if they are not sure what tariffs will apply when the metal arrives. So silver that might normally flow freely between New York, London, Shanghai, and other markets has started getting stuck. Arbitrage opportunities that would normally equalize prices across regions are not working because the logistics and regulatory uncertainty make the trades too risky. All of these factors converged in September and October 2025. The result was a full-blown liquidity crisis in the London market. Banks couldn't find metal to lend. Refiners couldn't afford to borrow. Industrial buyers were competing with investment demand for a shrinking pool of available silver, and the entire fractional reserve system that allows paper claims to vastly exceed physical metals started showing cracks. Here's where the Shanghai angle comes in, and why regional price dislocations are becoming extreme. China is the world's largest consumer of silver for industrial purposes. Chinese solar panel manufacturers, electronics producers, and other industrial users need continuous silver supply. The Shanghai Gold Exchange and Shanghai Futures Exchange are where Chinese entities trade silver. When London's availability tightened and lease rates spiked, Chinese buyers faced a choice. They could try to import silver from London or New York, dealing with shipping delays, customs, potential tariffs, and financing costs. Or they could pay whatever price was necessary to secure silver within China. Many chose the latter. Shanghai premiums, which measure how much more silver costs in China compared to London, started widening. In normal times, these premiums might be 50 cents to $1 per ounce, reflecting shipping and financing costs. But as the global shortage intensified, regional premiums exploded. Reports from market participants indicated premiums of multiple dollars per ounce in certain Asian markets. Now, here's the critical point. If Shanghai physical silver were trading at $73, while London spot was at $65, that would represent an $8 premium. Is that happening? The data is opaque. Shanghai prices aren't reported with the same transparency as London or New York, but the conditions exist for exactly that kind of dislocation. Think about the logic. If you're a Chinese solar panel manufacturer and you need silver to keep your production line running, what's your alternative? You can't substitute another material. You can't wait months for cheaper silver to become available. You have contracts to fulfill, workers to pay, customers demanding delivery, so you pay whatever the market demands. And if London can't deliver metal because everything is tied up in ETFs or long-term industrial contracts or simply doesn't exist beyond the paper claims, then Shanghai silver trades at whatever clears the local market. That could easily be $73 or higher in situations of acute local shortage, even while paper markets in the West show $65. This is the fundamental disconnect that's emerging. Paper markets, where you can trade futures contracts or buy shares of ETFs, show one price. Physical markets, where you actually need deliverable metal in your hands, show another price. And the gap between them is widening. Let me show you how bad this got. In October, market participants were chartering cargo planes to fly silver bars from New York to London, not cargo space on commercial flights, dedicated freight aircraft. Because the arbitrage opportunity was so extreme that even with the cost of air freight, which is multiples more expensive than shipping by sea, it was still profitable to physically move metal across the Atlantic. That tells you everything about the severity of the shortage. When it's economical to put silver on airplanes rather than waiting for ships, the market is broken. Bloomberg reported on this phenomenon. The Financial Times covered it. Industry insiders confirmed it. This isn't speculation or conspiracy theory. Major bullion banks and trading houses were literally flying silver across oceans because London couldn't source enough metal locally. And here's what makes this even more significant. The total amount of silver that can be moved by air freight, even with dedicated cargo planes, is a drop in the bucket compared to global demand. You might move a few million ounces this way, but daily trading volume exceeds 600 million ounces. The physical flows cannot possibly satisfy the paper claims. That's when the paper market starts to crack. When enough people who think they own silver through futures contracts or ETF shares or bank accounts decide they want actual metal, the system can't deliver. There isn't enough physical silver backing all the paper claims. The ratio of paper claims to physical silver available for delivery has been estimated by various analysts at anywhere from 100 to 1 up to 250 to 1. The exact number is debatable because it depends on definitions and what you count, but the directional truth is undeniable. There are far more paper claims on silver than there is actual silver available to satisfy those claims. This worked fine for decades because most people never demanded delivery. They were content to trade paper, roll their futures contracts forward, hold ETF shares. But when stress hits the system and people start demanding physical metal, the illusion collapses. That's what October 2025 represented. Not the full collapse yet, but the first real cracks. Lease rates spiking to 39% was a warning signal. Backwardation of $2.88 was a warning signal. Air freighting metal across continents was a warning signal. Refineries stopping purchases was a warning signal. Each of these events individually would be notable. All of them happening simultaneously within a few weeks is a flashing red alarm that the system is under unprecedented stress. Now let's talk about what happens next, because this story is far from over. The immediate crisis has moderated somewhat. Lease rates came down from the 39% peak to around 10 to 11% as of mid-November. That's still 10 times normal, but it's not the extreme spike we saw in October. Backwardation has narrowed as silver was moved from New York to London to relieve some of the pressure. The air freight arbitrage opportunity has mostly closed. Surface level calm has returned. But the underlying fundamentals haven't changed. The supply deficit is still 118 to 149 million ounces for 2025. Industrial demand is slowing down. Solar panel production is growing. Electric vehicle adoption continues. Investment demand remains robust as people seek alternatives to fiat currencies that are being debased through constant money printing. Mine production isn't going to surge. It takes years to develop new mines. Existing mines are running at capacity. There is no cavalry coming to bail out the supply side. Above-ground stockpiles are depleted. COMEX registered silver stocks. The metal available for immediate delivery fell 70% from their 2020 peak. London vaults are down 50%. ETFs have absorbed over 1 billion ounces. The buffers that used to absorb temporary supply-demand imbalances are gone. So we're left with a structural shortage in physical silver coexisting with a paper market that continues to function as if there's abundant supply. And every time stress builds in the physical market, we get these periodic crises where lease rates spike, premiums explode, and people scramble to move metal around the world to plug holes. Bank of America raised their 2026 silver price target to $65, making them the first major bank to take such a bullish stance. But even that might be conservative if the supply situation deteriorates further. Some analysts are talking about triple-digit silver, not next month, but as the logical endpoint if the supply deficit continues and paper markets lose credibility. If industrial users can't get silver at quoted prices, they'll pay whatever it takes. If investors lose faith in paper claims and demand physical delivery en masse, the price has to adjust to clear the market. Would that adjustment take silver to $73 in Shanghai while London trades at $65? It's not only possible, it's exactly what you'd expect in a market undergoing dislocation. Prices converge when goods can flow freely. But when logistics break down, when financing becomes prohibitive, when regulatory uncertainty freezes trade, regional markets can diverge significantly. That's what we're seeing in embryonic form right now. Regional premiums that would have been 50 cents a year ago are now multiple dollars. As stress intensifies, those premiums could widen further. Here's what you need to understand about the broader implications. Silver is not just a precious metal. It's a critical industrial commodity that modern civilization depends on. The green energy transition cannot happen without silver. The technological infrastructure of the 21st century cannot function without silver. If silver becomes genuinely scarce in physical form, if prices have to rise dramatically to equilibrate supply and demand, the ripple effects will be enormous. Solar panel costs increase. Electric vehicles become more expensive. Electronics prices rise. The entire cost structure of the modern economy gets impacted. At the same time, silver serves as a monetary metal. People buy it as insurance against currency debasement, banking system instability, and geopolitical risk. When the financial system shows stress, demand for physical precious metals increases. That's exactly what we're seeing in 2025. The combination of industrial demand that cannot be deferred and monetary demand driven by macroeconomic concerns creates a squeeze unlike anything most markets experience. Oil can be substituted with other energy sources to some degree. Agricultural commodities can be replaced with alternatives if prices get too high. But silver's unique properties make it irreplaceable in many applications. This is why the physical shortage matters so much. This is why lease rates spiking to 39% is such a big deal. This is why airlifting silver across oceans is significant. These are symptoms of a system that's running out of slack. The paper market can pretend there's abundant supply. Futures contracts can be created at will. ETF shares can be issued as long as there's demand. But actual physical deliverable silver bars exist in finite quantities. And those quantities are proving insufficient to meet the combined demands of industry and investment. When Shanghai needs silver and London can't deliver it at the quoted price, Shanghai pays more. When that premium reaches $73 or higher, it's not because of speculation or manipulation. It's because that's what it takes to clear the local market given the constraints on global supply and the difficulty of moving metal quickly across borders. This is the new reality of precious metals markets in 2025. The era of abundant supply at modest premiums is over. The fractional reserve system that allowed paper claims to vastly exceed physical metal is breaking down, and regional price dislocations are becoming the norm rather than the exception. For anyone holding paper silver, these are uncomfortable truths. That futures contract might not be deliverable when you want it. That ETF share might not be redeemable for physical metal in a crisis. That bank balance showing silver ounces might just be an entry in a database with no corresponding physical metal backing it. The people holding actual physical silver, whether in allocated storage or in their own possession, are discovering that their metal is worth more than the paper price suggests. The premiums prove it. The lease rates prove it. The backwardation proves it. The desperate scramble to source metal proves it. This is what a market looks like when it transitions from paper dominance to physical scarcity. It's messy. It's volatile. Prices gap and spike. Regional markets diverge. Traditional pricing mechanisms stop working. And the disconnect between what things are supposed to cost and what people will actually pay widens into a chasm. We're watching it happen right now. The October 2025 crisis was just one chapter in a longer story that's still being written. The lease rates came down from 39%, but they didn't go back to 1%. The backwardation narrowed, but it didn't disappear. The physical shortage eased slightly, but it didn't resolve. The underlying imbalance remains. And every time the system gets stressed, we're likely to see another spike in lease rates, another round of premium expansion, another episode of people asking why they can't get physical delivery at the quoted price. That's the world we live in now, where Shanghai might pay $73 for silver while paper markets show $65, where that $8 gap represents not inefficiency, but the true cost of obtaining physical metal in a world where physical metal is genuinely scarce. Welcome to the end of the paper-silver era. What comes next is anyone's guess. But one thing is certain. The people holding real metal are going to be a lot better off than the people holding promises.